Okay, now we're going to take a look at exercise 2.7. Here we're just going to create journal entries. The first problem, or the first portion, is the transaction purchased raw materials on account for $46,300. Well, if you think about that, purchasing raw materials on account, it's going to be an accounts payable. And the first thing we'll do is debit our raw materials inventory for $46,300, and we will credit our accounts payable for $46,300. The key here is when it's purchased on account, you know it's going to be an accounts payable. Raw materials will go directly into raw materials inventory. Know that when raw materials go into either direct materials, and raw materials inventory can also go into indirect materials. So when jobs are being worked on, the raw materials account would be credited, and the debit to that work in process can take the place in the form of direct materials or indirect materials. Now we know that the indirect materials will go into a manufacturing overhead account, and those raw materials will go into work in process. So I hope I haven't said too much, but I just want to keep reiterating that a raw materials inventory account can go into manufacturing overhead, just like factory labor can go into direct labor, or it can also go into manufacturing overhead. Okay, the next question or transaction, raw materials of $36,000 were requisitioned to the factory. An analysis of the material requisition slips indicate that $6,800 was classified as indirect materials. Now, when it's requested to the factory, that means they're working on something. So what will happen in that is the amount that is indirect materials will go directly into manufacturing overhead, and the difference will go directly into work in process. So our work in process is going to be the $29,200, because we know 36,000 of it was requested and 6,800 of it is going to be manufacturing, manufacturing overhead, manufacturing overhead is going to be our debit too of 6,800, and out of the raw materials inventory we're going to credit the entire amount of 36,000. Okay, our next one, a transaction factory labor costs incurred were $55,900, of which $51,000 pertained to factory wages payable and $4,900 pertained to employer payroll taxes payable. So what we'll do here, it's always going to be a debit to factory labor of the amount of $55,900. Of that, we're going to have factory wages payable of the net difference between the entire amount of $55,900. Oh, it's telling us $51,000 pertains to factory wages payable, so the 51 is going to go here, and the $4,900 will be a credit to employer payroll taxes payable. Okay, as we move on, time tickets indicated that $50,000 was direct labor and $5,900 was indirect labor. So again, from here, we're going to show work in process inventory of $50,000. We're going to show manufacturing overhead, because remember, all of our manufacturing overhead costs are going to get put into the manufacturing account, and it's going to be accumulated, the actual cost. And then we are applying that at a predetermined rate, and then after that we'll figure out the delta on the actual versus the applied. But in here, the indirect labor was $5,900, and the total amount will be credited factory labor in the amount of $55,900. Okay, as we move on, the next one says that manufacturing overhead costs incurred on account were $80,500. So it shows that we'll have manufacturing overhead of $80,500, and it was incurred on account. Accounts payable of $80,500. Next, we see that depreciation on the company's office building was $8,100. Now, this is a trick one, because when equipment is being depreciated as it relates to the factory, then that would be manufacturing overhead and a credit to accumulated depreciation. But in this scenario, it's on the office building. So this is a period expense, which means depreciation expense of $8,100, and our credit will be accumulated depreciation of the building of $8,100. Next, manufacturing overhead was applied at a rate of 150% of direct labor cost. So we know here that this is the predetermined overhead rate. And so what we'll do here is show the predetermined overhead rate of, and bring it into work in process, inventory, and 150% of direct labor costs. If we know that our direct labor costs are $50,000, then 150% of the direct labor costs up here of $50,000 would be debited to work in process, and that would be $75,000. Now the credit on this is going to be credited to manufacturing overhead, and this is applied of $75,000. Next, we've got goods costing $88,000 were completed and transferred to finished goods. So what we'll do here is we're going to take out of work in process and transfer them to finished goods. So we'll have a debit to finished goods inventory of $88,000 and a credit to work in process inventory of $88,000. Then it tells us that the finished goods that cost $75,000 to manufacture were sold on account for $103. Now there are two transactions we have to handle here, because we have to show the sales and the revenue associated with that. And we also need to clean up the credit the finished goods and debit our cost of goods sold. This is at the time it becomes from the balance sheet to the income statement. So we will show accounts receivable of 103. We'll show sales revenue of 103. And then we will also show a debit to cost of goods sold of $75,000, and our credit is going to be finished goods. Finished goods inventory of $75,000. Remember, it is at the point when the transaction takes place, the sale of the goods, that they no longer are in inventory, and they go from finished goods, a reduction in finished goods, and they become now on the income statement as the account cost of goods sold. So I hope these help you in understanding the exercises from this chapter.